All right, buddies. It is the conceptual reframing part one. This video is based on the article uh, on current issue for strategic business reporting, conceptual reframing. Right, you may have got the idea. Right, in March 2018, in March 2018, IASB published a revised uh, conceptual framework, framework, and it will be effective from January 2020. Okay. One of its key objectives is to ensure that financial will help users assess management stewardship. Okay, one of its objective is to ensure that that financial help users will assess management stewardship. Sorry, management stewardship. All right, so far so good. The new framework make the little changes to the characteristics of useful information. All right, the exercise of column when making judgments under condition of uncertainty, and it doesn't allow under or overstatements of assets or liabilities, increase or decrease of expenses. Right. So the little changes. What are the little changes? Little changes as per the new revised conceptual framework is that to avoid the uncertainty, and now it does not allow over or understatement of assets and over or understatement of liabilities, right? It doesn't allow that. It also have some little changes in qualitative characteristics. And qualitative characteristics. And what are those? Useful information still relevant. All right. So according to new changes, useful information is still relevant as per the new framework. Faithful representation also relevant. Faithful representation relevant. Then we have, but information should be, the changes information should be more comparable, right? More comparable on, comparable. It should be more verifiable, It should be more verifiable and understandable and should be timely. It should be more understandable and more timely. Right, so far so good. We have some new definitions. We have some new definitions, all right, in the framework. First of all, we have new definition of reporting entity, which was not there before. All right, reporting entity. What is reporting entity? An entity that is required or choose to prepare, that is required or choose to prepare financial statements or choose to prepare or choose to prepare financial statements, or group choose to prepare, the whole group choose to prepare financial statements. That's the definition of the reporting entity as per the uh, IASB. All right, it also defines the reporting entity boundaries, including, all right, including it defines the boundaries of the reporting entities, right, which includes what the boundaries of the reporting activities includes the situations where it is not situations where it is not legal entity, okay, where it is not a legal or entity or form a part of a group or not form part of group, right, uh, part of a group of entities through parent or subsidiary relationship, through parent or subsidiary relationship, right? So the important thing, the important idea in this definition determination is that boundary of reporting entities with reference to economic activities with focus as information need of primary uh, users of the financial statements, right? We also have some changes in the definitions of assets and liabilities. Changes in assets and liabilities, right? So, what are the changes in assets and liabilities? All right. First of all, let us look at the asset. All right. Asset, old definition was, let me change the color for the old definition. That was the old definition, right? As per the old definition, what was it? Asset is a resource controlled by an entity as a result of past events. as a result of past events and from which uh, economic benefits are expected to flow to entity, right? Uh, that was the old definition. The new definition of the assets is a present economic resource, a present economic resource controlled by the entity, as a result of of past events. Okay, as a result of past events, economic resource is a right. Resource is a right. Is a right that has potential to produce economic benefits. So that's the new definition of asset. Okay. Then we have liability, right? Okay. Yeah. Then we have a liability, changes in liability, right? So again, let us look at the old definition first. What was the old definition? A present obligation of the entity, obligation of the entity arising from past events. The settlement which is expected to result, which is expected to result in an outflow in an outflow from entity of resources, from entity of resources embedding economic benefits, embedding economic benefits. So that was an old definition of liabilities. Right now we have again, let us look at the new definition of liabilities. What is the new liability? A present obligation of the entity to transfer an economic resource as a result of past events. Okay, an obligation is a duty or responsibility. An obligation is a duty or responsibility that the entity has no practical ability to avoid responsibility, that the entity has no practical ability to avoid. So that's the new definition of liability, and I hope you got it till here, right? So now, what are the important changes? Let us look at the important changes in asset definition. Okay, the important changes in an asset definition is number one, it is a right. Okay, it is a right. Number two, it provides more clear basis. Number three, now asset will be defined with their you know inherent qualities, inherent qualities rather than not by their subjective, not by subjective expectations. Okay, so far so good. Now, what are the changes in liability? Changes in liability. Well, changes in liabilities are mostly you can found in their wording and emphasizes, right? The mostly the wording and emphasizes has been changed, right? It is now less subjective. Now less subjective means it is less quantitative, less subjective in determining the scope of the liability, the scope of liability, right? So it is debatable whether the word no practical ability provides meaning beyond advising sense of word. It carefully places emphasize as present nature of obligation. So revised framework mostly stresses the need for prudence and management stewardship. It defines reporting entity, new definitions of assets and liabilities. We are already seeing new thinking in new standards. For example, in IFRS 15, right? For example, in IFRS 15, you can see uh, the wording of where revenue recognition is based on performance obligation. All right, where it is based on performance obligation, this represent that control should be uh, viewed. The control should be viewed rather than uh, an it is an rather than the monetary terms. The control need to be viewed, and also ideal basis for separation has to be looked. All right. Again, IFRS is far more able to gap with the complication that arise in revenue recognition rather than in its procedures in IS 18 or 11 before, right? Also, changes come in other standards. We can also expect to see some more changes in future in IS 19 and IS 20 due to the changes in the standards in the framework, right? So both of which have requirements that can be reduced to obligations and rights, right? And in second part, which will be coming soon, we will study the recognition criteria, the derecognition criteria, the measurement criteria, and presentation and disclosures of the revised conceptual framework. So I hope you get it. See you, folks.